Kenafric Industries is one of East Africa's most powerful and diversified manufacturing companies, producing a wide range of everyday products that millions rely on. From lollipops, fresh chewing gums, mchuzi mix, flip-flops, and even exercise books. Kenafric is everywhere, at home, in schools, and on the streets. Founded in 1987 in Nairobi, Kenya, this family business started with just plastic footwear. Today, it operates on a massive 25-acre facility, employs over 1,500 people, and generates an estimated $325 million in annual revenue. Its products are sold across 14 African countries, and it ranks among the top fast-moving consumer goods manufacturers in East Africa. So, how did this family-run business become a household name in just a few decades? And what does it take to build one of the most successful manufacturing brands on the continent from scratch? But before we continue, if you find this video interesting, make sure you like and subscribe for more captivating stories. Kenafric Industries' roots trace back to Velji Punja Shah, a migrant from India who came to Kenya in the mid-20th century. He arrived in Nairobi, where he built a modest but robust trading business. His firm specialized in the distribution of fast-moving consumer goods, dealing with both local products and international brands. Velji was a man of discipline and principles. His reputation as a reliable businessman grew within Nairobi's tight-knit business circles. As the business flourished, his four sons, Bharat, Ketan, Mayur, and Nilesh, joined him, gaining hands-on experience in sales, supply chain management, and customer service. This period laid the foundation not just for business acumen, but also family unity and resilience, two values that will serve the Shah family in the most challenging times ahead. In 1982, Kenya went through a major political shock. A failed coup attempt against President Daniel Arap Moi led to widespread unrest, looting, and economic paralysis, particularly in Nairobi. Among the many victims were the Shahs. Their business, built through years of sweat and sacrifice, was completely looted and destroyed. Every warehouse, every product, every inventory item they had, gone. The financial loss was so immense, many would have given up or moved back to India. But the Shah family made a critical decision: they will stay, rebuild, and find a way to survive. This moment became the crucible in which Kenafric was born. 5 years after losing everything, the Shah family re-emerged with a bold new plan. In 1987, they acquired a small plastic footwear manufacturing facility. It was a major pivot from trading others' products to making their own. They named the new company Kenafric Industries Limited, a blend of Kenya and Africa, symbolizing their African identity and Pan-African ambition. Their first breakout product was a women's plastic sandals called Dancing Queen. The name evoked fun, color, and affordability, everything that appealed to their target market. The product caught on rapidly, not only in Kenya, but also in Uganda and Tanzania. This success proved two things: the family could succeed in manufacturing, not just trading, and the East African region had a huge untapped demand for locally made affordable consumer goods. By early 1990s, the family faced another strategic challenge. The price of oil, a key component in the production of plastic goods, began to rise sharply. This made manufacturing plastic sandals increasingly expensive and less profitable. Rather than ride out the decline, The Shahs, again, chose to pivot. They bought a second-hand bubblegum machine from Taiwan and entered the world of confectionery manufacturing. It was a risky bet. They had little experience in food production, but they saw a clear market gap: affordable sweets for the youth market. They launched a line of bubble gums that quickly gained popularity. The products were colorful, fun, and cheap, ideal for school-going children. Their gums became staple in shops, kiosks, and school truck shops across Kenya. This marked a turning point. Kenafric was no longer a plastic shoe maker, it was now a food and confectionery brand. The 1990s saw Kenya liberalizing its economy, including relaxing import-export restrictions, removing exchange controls, and encouraging private sector participation. This climate was favorable for companies like Kenafric that had matured locally and wanted to expand regionally. Kenafric realized that many neighboring countries, especially in East, Central, and Southern Africa, had underdeveloped manufacturing bases, but growing demand for fast-moving consumer goods, especially affordable confectionery. While the groundwork was laid in the late 1990s, Kenafric formally entered the export market in 2000. The initial approach was identifying countries with high demand and low local competition, such as Uganda, Tanzania, Rwanda, and Ethiopia, partnering with the distributors in target markets rather than opening branches initially, and customizing products and packaging to suit regional tastes and regulatory standards. Within a few years, Kenafric's products were being distributed in over 30 countries, including parts of West Africa, Southern Africa, and the Middle East Africa. To solidify its export footprint, Kenafric invested in regional manufacturing. For instance, they established operations in Uganda, allowing them to produce closer to key markets and reduce logistical costs. Their export growth was supported by economies of scale from mass production in Nairobi, a strong understanding of consumer behavior in African markets, and investments in branding, logistics, and distributor support. In 2002, Kenafric Industries expanded its footwear portfolio by formally integrating slippers into its product range, a pivotal move that aligned with the company's mission, which is to offer affordable and practical everyday solutions for its consumers across East Africa. Having already built a strong foundation in PVC shoes and school footwear since the late 1980s and 1990s, Kenafric recognized a growing market need for comfortable, versatile, and home-use footwear. The introduction of slippers allowed the company to meet this demand directly. The slippers were locally manufactured, making them more affordable than imported alternatives. This was especially impactful in low to middle income households looking for durable, daily use footwear. Slippers were aligned with comfort and utility in mind, ideal for indoor use, markets, casual outings, or even as school and shower footwear. This addition helped Kenafric to tap into new customer segments, including homemakers, children, and rural communities who valued functionality over fashion. By providing reliable and budget-friendly slippers, Kenafric helped elevate the quality of life for many households, offering dignity and comfort in daily routines. This expansion was not just a product decision, it was a strategic enhancement of the brand's social footprint, reinforcing Kenafric's role in shaping accessible consumer goods in East Africa. In 2016, Kenafric Industries found itself needing to adapt. Although it was already a well-known name in Kenya and East Africa, its growing number of business segments, ranging from confectionery to footwear, culinary goods, and stationery, had become difficult to manage under a single corporate structure. The leadership realized that to survive and grow in a more competitive and regionalized market, they had to rethink how the business was structured and managed. The first major move was a strategic divestment. in the form of a particular sale of the business. Kenafric brought in two private equity investors, Amethyst Finance, a French investment fund, and Mitaya Private Equity, a South African firm. These firms didn't buy into the whole company. Instead, they took a 40% stake, specifically in Kenafric's confectionery and culinary divisions. This was significant for two reasons. First, it allowed Kenafric to raise new capital without giving up control of the entire business. Second, it created a natural segmentation within the company, which helped streamline focus and accountability. With that deal in place, the Shah family, the founders and majority owners, retained full control of the footwear and stationery business. The confectionery and culinary segments, on the other hand, became a joint venture with the Tropical General Investment Group, a multinational conglomerate based in Nigeria. The joint venture was named Kenafric Products Limited. Kenafric retained controlling interest, but operational and strategic decisions were now shared between the Shah family and TGI. The investment capital wasn't just sitting in the bank. It was immediately put to work to modernize the company's operations and expand its footprint. One of the most significant developments was the planned entry into the Ethiopian market. Kenafric announced a 500 million Kenyan shillings, approximately $5 million investment to build a new manufacturing plant in Ethiopia. Ethiopia was chosen for its large, youthful population and rapidly growing demand for fast-moving consumer goods. This move positioned Kenafric to become a truly regional manufacturer, not just a Kenyan brand. At the same time, Kenafric began reforming its internal structure. Prior to this shift, the company had operated more like a typical family business, where key decisions were made informally or concentrated among a few individuals. In 2016, that changed. Kenafric started bringing in experienced professionals to lead departments, especially in finance, operations, marketing, and human resources. It also introduced clear reporting structures, performance monitoring systems, and external advisory support to align operations with the internal standards. It looked for strategic acquisitions to solidify its market position. In the same year, Kenafric acquired Economic Industries Limited, a major local player in the stationery sector. This acquisition included well-known brands like Falcon and Economic, which were already popular in Kenyan schools and offices. The result was a dramatic increase in market share. Kenafric's presence in the stationery industry jumped from 12.3% to 22.6%, making it the second largest stationery company in Kenya. The deal was a perfect example for market consolidation, executed to scale up operations in sectors where Kenafric already had a presence. Also, Kenafric Industries acquired the Oyo brand in July 2009 from GGB Foods Limited, a Spanish food processing firm. Oyo is a well-known African culinary brand, particularly recognized for its food spices and starch powder products that enhance flavor and texture of home-cooked meals. This acquisition was part of Kenafric's strategic diversification beyond its core confectionery and footwear businesses. By adding Oyo to its portfolio, Kenafric strengthened its position in the culinary segment, competing with the established players like Unilever's Royco. The move leveraged Kenafric's robust distribution network across East Africa, enabling the company to introduce Oyo products to a broader market. In 2021, Kenafric Industries launched a new line of beverage products from its recently commissioned plant. The products include Safi drinking water, Mr. Twister fruit-flavored drinks, and Steam Energy drink, available in various packaging options. Safi H2O is a bottled water brand available in multiple sizes ranging from 0.33 liters to 20 liters to cater to diverse consumer needs. The water is marketed as natural drinking water, emphasizing convenience and health benefits. Steam Energy Drink is Kenafric's foray into the energy drink segment, targeting consumers seeking an energy boost. While the specific details about its formulation and market performance are limited, the product represents efforts to diversify its beverage offerings and meet the evolving preferences of its customer base. By 2021, Kenafric was actively diversifying, looking to expand into fast-growing, high-demand segments of the consumer goods market. One such category was biscuits, a daily staple in many Kenyan and East African homes. But biscuits required serious investment in production lines, food technology, and branding. Instead of building it from scratch, Kenafric looked for a partner. Britannia Industries, one of India's top food companies, was already a giant in the biscuit space. They saw an opportunity in East Africa, especially in Kenya, with its growing consumer class, supermarket culture, and regional trade access. But rather than entering alone, Britannia took the joint venture route, a way to minimize risk, gain load insight, and fast-track entry. In October 2022, Britannia, through its Dubai-based subsidiary Badco, acquired a 51% controlling stake in a new company, Kenafric's Biscuit Limited. Kenafric retained 49% ownership, meaning it stayed deeply involved but allowed Britannia to lead operations. The purchase price of around 13.87 million Kenyan shillings was modest, showing this was more of a strategic long-term investment rather than a purely financial acquisition. Britannia brought its world-class product development capabilities, while Kenafric handled the sales, logistics, and market rollouts across Kenya, Uganda, Tanzania, Rwanda, and DRC. Kenafric Industries has positioned itself as a dynamic and forward-thinking fast-moving consumer goods leader in East Africa. Through strategic diversification into beverages, culinary products, and biscuits, alongside key partnerships like one with Britannia, it continues to expand its footprint across the region. Kenafric's story is one of innovation, adaptability, and a clear vision to shape the future of consumer goods in Africa. Thanks for watching. I'll see you in the next video.